People look at stock prices all the time, but how do you actually value a stock? I'm Dylan Lewis from The Motley Fool. In this FAQ, we're going to walk through some of the common ways that people value stocks and how you can use easy valuation tricks to know what you're buying. One of the common approaches to valuing a company is looking at the PE ratio. This measures a company's current value against how much it actually earns in income, and you can calculate it one of two ways. First, by either taking a company's market cap and dividing it by net income, or dividing a company's current stock price by the company's earnings per share. So if a company's stock trades for $50 and there are 10 million shares outstanding, it is worth $500 million. And we'll say for this example, it has $25 million in net income. You could get the PE ratio by dividing 500 million by 25 million, or by dividing the share price of $50 by the earnings per share of $2.50. Either way, you get a PE ratio of 20. You'll wind up with the same number either way because in the share price approach, both numbers have already been divided by the total number of shares the company has outstanding. So it's two different ways to the same place. Now you'll usually see the PE ratio quoted two different ways. Trailing 12-month, or TTM, which looks at the company's actual income over the past 12 months, or forward. This approach takes an analyst estimate or a series of analyst estimates and looks at the earnings expectation for the company over the upcoming year and then uses that as the earnings figure. If a company is growing, its forward PE ratio will always be smaller than its trailing 12-month PE ratio because more income is expected and the denominator will be larger. If you see a PE ratio out in the wild and it isn't specified which kind it is, you can probably assume it's based on a company's trailing 12-month earnings. The PE ratio only works if there's an E, or earnings. So it's a helpful tool for companies that have income, but it's totally useless if a company is not currently profitable. That's why investors use another tool. For unprofitable companies, the PE ratio would return a negative number, which wouldn't really be very helpful. So instead, investors use a price to sales ratio. This is a company's market cap divided by its total sales over the past 12 months. High-growth software companies can have price-to-sales ratios of over 10, while more established businesses are usually in the mid to low single digits. The PE and PS ratios are great because they allow you to normalize companies of different sizes and immediately get a sense of what investors are willing to pay for a piece of that company's earnings or revenue. You can use these ratios to compare how a company stacks up to the overall stock market, peers in their industry, or itself relative to the past. Generally, businesses that are posting high growth rates are going to have high price to earnings and price to sale ratios. That's because investors expect that company to be considerably bigger in the future, and they have bid up shares to reflect that. That doesn't mean they're bad stocks to own, it just means that people are expecting big growth to continue, and if it doesn't, shares could fall dramatically. Conversely, stodgy old businesses in crawling industries tend to have lower PE ratios because they aren't growing very quickly. For them, this year's earnings will probably look a lot like last year's. The market isn't expecting much from stocks with low valuations, so if the outlook gets worse, they're less likely to take a huge hit, but they're also less likely to give investors huge returns. By now, you've probably realized that these aren't very complicated calculations to do. Valuation sounds scary to new investors, but really all you're trying to do with these numbers is get a sense of how much you have to pay for a dollar of earnings or revenue from a company and what the market expects from that company. There's one more easy valuation metric you can look at to see how a company's valuation compares to the growth the company is posting, and that's the PEG ratio. The PEG ratio takes the value from a company's PE ratio and then compares it to the company's earnings per share growth rate. So to calculate it, you first find the PE ratio for a company and then divide it by the year-over-year earnings growth rate. Going back to our $500 million business from before, they have a PE ratio of 20. Let's say that they grew their earnings per share at 15% in 2019. Putting 20 over 15, we see that they have a PEG ratio of 1.33. The generally accepted rule is that a PEG ratio of 1 represents a fair value, while anything under 1 is cheap and anything over 1 is expensive compared to the growth the company is posting. For all these ratios, these rules aren't absolutes, just guidelines. As investors, we're looking for quality companies with good business models and exciting growth prospects. It's worth paying a premium for companies like that. These metrics help us understand what the premium looks like and how it fits into the company's growth story. There are more advanced ways of valuation. They usually involve spreadsheets, models, and discounted cash flows. Don't worry about that kind of stuff right now. If you have these basics down, you'll be able to understand most conversations around how to value companies, and most importantly, be able to understand what you're buying when you decide to buy a stock. And if you're looking for help with investing, we've got a free starter kit for you. It covers everything from opening a brokerage account to buying your first stock, and it comes with 5 great stocks to get you started. You can get that for free over at fool.com/start. That's going to do it for this FAQ. We want to know what stocks you're interested in and what questions you might have. Drop those down in the comments section below. And be sure to hit that thumbs up button below to like the video, and make sure to subscribe to get more content like this from The Motley Fool. Until next time, Fool on.